So, what does an inverted yield curve mean for you in your portfolio? A normal yield curve is upward sloping. Typically, you have your shorter dated maturities, your 1 month, 3 month, and 6 month treasuries yielding lower than your longer dated maturities, which are your 10-year, 20-year, and 30-year maturities. Whenever the difference or the spread in rates and yields on the yield curve start to converge or come closer together, we have a situation that is known as a flat yield curve, or a yield curve that is in the process of flattening. An example of this is a 3-month treasury that is yielding approximately the same as a 10-year treasury note. An inversion of the yield curve typically takes place when the shorter dated maturities are yielding more than the longer dated maturities. For example, that 3-month treasury that I mentioned before, when that's yielding a higher yield than the 10-year treasury or the 20-year treasury, the shorter dated maturities are higher than the longer dated maturities. Therefore, the yield curve is inverted or sloping down, or often called backward dated. Over the past 2 years, approximately, we've noted a flattening in the yield curve. Our research has continued to show us the yield curve is flattening throughout several levels of it, from the short end through the middle down to the long end of the curve. And as the curve continues to flatten, inversion is typically the next step that it takes. And that's currently where we are today. With the inverted yield curve, there's a few things that you will have to watch out for and be prepared for as you move forward in this investment landscape. When the yield curve is inverted, this is typically a sign of softness or weakness ahead in the market. Typically, investors pay close attention to the bond market and the yields and the rates in the bond market. And whenever there is instability about future rates or instability about future returns in the market or about the economy and overall, investors will tend to shift portfolio allocations to shorter dated maturities, shorter dated bonds as a safe haven. This flock to safety often causes shorter dated maturities to have a higher yield than longer dated maturities, in turn producing an inverted yield curve. The theory and the economics behind why the yield curve inverts is pretty simple. Think about it this way. If you are a lender and you're lending someone money and you foresee that the economy is not going to be doing so well or so hot over the near term or intermediate or long term future, would you prefer to lend them money for a short term or a long time period? Same is true in the investing world. When investors and institutional money managers see that the economy is not doing so hot or that we may be cooling, we tend to pull our investments off the table, away from risky assets, and invest in safe haven assets such as fixed income bonds and treasuries. And in doing so, we often transition to shorter dated treasuries that are 3 months, 6 months, 2 years on the yield curve, as opposed to treasuries and bonds that are 5, 10, 15, and 20 years. I'd rather lock up my money for a short period of time when there's a lot of uncertainty in the market, as opposed to locking up my money for a long period of time when there's uncertainty in the market. One thing that we must be cognizant of is that an inverted yield curve does not equate recession. An inversion of the yield curve is nothing more than an indicator of potentially what's going on in the future or what could happen in the future, what traders are forecasting interest rates will be and what inflation will be in the future. So if you have longer dated maturities that are yielding a lower rate, essentially the economy is saying that inflation is going to be lower in the future. Growth aspects will be lower in the future. And that's something that we should definitely focus on from an investment standpoint. Additionally, with the trade war and the current tension between the United States and China, there's additional headwinds that are in the way that could produce a tsunami effect or can produce more of a ideal environment for a potential recession. Our research continues to highlight the theme that we are in the latter stage of this bull market. If you look at the increased volatility that we've seen over the last 15 months, which is typical of the end of a bull cycle, and you couple that with the inverted yield curve as well as having full employment in our economy, all the signs point to us being in the latter stages of this bull market and coming in for a landing. Now the big question is, will this be a soft landing or a hard landing? We do not believe that we will see a recession in 2019, although we do feel that the current stance and position of monetary policy and fiscal policy in this country has created an atmosphere where we are primed for an economic downturn in the future. Therefore, as an investor, when you see recessionary indicators such as the inverted yield curve, it's important to understand that it is an indicator and that it should be viewed in totality with the full economic picture. Also understanding that as an investor, the best way to mitigate risk and volatility in the market is by maintaining a fully diversified portfolio, a portfolio that meets your needs and your objectives for your specific time frame. If you have any questions about any market volatility or uncertainty right now in our investment landscape, please reach out to Warwick Shore Advisors or leave a comment below and I will personally answer those.